Welcome, everybody. Today is Thursday, March 17th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and editor of Alpha Insights. And this is your Daily Five. Daily Five, as you know, is the show where we go through the five most important charts that we're looking at this week, right now, and what it means for you. So let's jump right into chart number one. Chart number one looks at the 10-year Treasury yield. Now, we've been talking about this for some time. People that have followed our work are probably aware of it. The 10-year is probably the single most important factor that affects valuations across the board, all asset classes for that matter. When the 10-year rate is rising, then PE multiples tend to compress, real estate cap rates tend to rise, and bond prices decline proportionally. There's an inverse relationship between rates and prices with bonds. So the 10-year note yield is really appears poised to have already resolved a classic pattern-based formation of the inverted head and shoulders variety. There's a lot of different ways you can draw the lines to illustrate that. We've chosen to draw them the way we are presenting them today. And there's a couple of relationships here. But the most important one is the fact that the bullish inflection above 1.8% now projects a measured move to approximately 3%. And one of the observations that I like to point out here is that the path from 3% to 2% back from the peak in 2018 throughout 2019 really only took about 9 months. And so based on the idea of time symmetry, it's certainly possible that a move back to 3% from 2%, where we went out just last Friday, could occur before year end, could take about the same amount of time. And frankly, we got up to just around 220, a little over 220 the other day, and we pulled back from there, as you can see, around 215, 216. And the idea here is that if in fact we do hit 3%, there are going to be some big changes in the market in terms of valuations, whether it be equities, real estate, or fixed income assets. All will be impacted, all will be impaired to some extent. And so the question is, how do we as investors adapt to that? So let's take a look at chart number two. Chart number two gives us at least one idea of how we can kind of evaluate this. And what we're really doing is we're trying to look at style leadership and sector leadership. And on the left-hand side, we are looking at the Invesco Pure Value and Pure Growth indexes. These are the ETF proxies, and we were looking at them on a relative rotation graph. What we can see is that for some time now, actually about the last 3 months, relative value, or I should say pure value rather, has been leading in the relative rotation relationship between the two versus the S&P 500, of course, and has been relatively strong. It's now turned over in the last few days, just I think with a lot that's going on with the Fed and whatnot, and just a lot of volatility in the market in recent days. But the pure growth index has been lagging for some time as well. And so this relationship has really kind of been in place for around the last, we can go back 26 weeks, but certainly the last 3 months, it's been very dominant. On the right-hand side of the chart, we can see sector leadership. And within the sector leadership quadrant, the leading quadrant that is, energy has been the dominant sector. And while it's showing some signs of waning momentum, it is still dominating every other sector on a relative basis. And also showing up in the leading quadrant are staples, utilities, financials, also basic materials. Real estate has slipped down into the weakening quadrant. And healthcare is also in the leading quadrant. You can't quite see it there. It's buried under a lot of the other lines and indications there. But what is painfully obvious is the fact that technology, consumer discretionary, and communications are all in the lagging quadrant or just on the border lagging, improving, but certainly to the left of the vertical center line, which really determines whether a sector is leading or lagging. And certainly the momentum would be improving if it's north of the center line. So what we're looking at here is some very specific sectors that are leading and a very specific style that's leading, as we've seen 10-year bond yields advancing above 2% and now into the kind of 220 area. So let's take a look at chart number 3 to get an even deeper look at what's going on in that pure value index and the pure growth index. Well, pure value on the left-hand side has about 123 unique constituents. And what I mean by that is that the 123 stocks that populate that index are specific to that index, and they are not included in the pure growth index at all. There's zero overlap. In the pure growth index, there are just a mere 57 constituents. And again, those are unique to the pure growth index. None of those constituents populate the pure value index. But what we can also see is that there's a dramatic difference in terms of the weighting of the various sectors. In pure value, we can see that financials are the dominant sector, about 31% versus just 12.4% in the pure growth index. We can also see that information technology is a mere 4.4% versus the 34.6% that it ranks in the pure growth index. Consumer discretionary is another big change. That slips down from around 14.5% to just below 7% in the pure value index. And if we take a look at energy jumps from a little over 5.5% to around almost 9% in the pure value index. What is also interesting is that what is completely absent from the pure growth index, and that would be materials and consumer staples, show very heavily in the pure value index. So consumer staples rank around 10% and materials just under 8%. So, we've got a very different complexion within that sector exposure between those two style indexes. And it's consistent with those leading sectors that are showing up in our prior sector leadership chart that are consistent with the pure value index as well. So what I like about these two indexes is the simple fact that they are independent of one another. So let's take a little bit deeper dive on that in chart number 4. Chart number 4 looks at the ratio of the pure value to pure growth indexes. And of course, we're using the ETF proxies of the two, and the symbols are RPV and RPG. So when we consider value versus growth, the first thing that I wanted to reiterate is the fact that the pure value index holdings really are unique, and they're driven by a core value style sort of algorithm. They're seeking out certain characteristics on a multi-factor screening process that has identified 123 issues that make up that index. And the same is true of the growth index. They use a multi-factor screening process, and it has identified just 57 issues that meet all of the criteria there. Again, there's no overlap. What's really important here is that if we examine the ratio, we can note that when the ratio is declining, value is underperforming growth. And when the ratio is advancing, value is outperforming growth. And if we look at the right-hand side of the chart, we can see that that ratio is put in a fairly obvious double bottom pattern. And that double bottom has resolved above its 2021 high. It's resolved above moving average resistance. We're using a 36-month exponential moving average to define the trend. And it's also closed now above trend resistance. If we just connect the dots from the prior highs, we have also taken out that trend line. And so, that gives us a lot of confidence that we've resolved this pattern to the upside. And it appears to us that there's a high probability of this continuing to advance going forward. What gives us a lot of confidence in that statement is when we look at the structural momentum study below, the lower panel of this chart. And the first thing that jumps out at us is that same double bottom type pattern has also resolved above its 2021 high and chart resistance levels. But what's less obvious, and if you drill down, you can see that momentum study has now posted a new all-time record high. That all-time record high gives us a lot of confidence in the strength of this relationship, especially since we're so early in the pattern's evolution. In other words, if we were kind of taking a look at that study and let's just say the ratio is trading at an all-time high, then we might conclude that, well, they're confirming one another's all-time high, and it's time to maybe be concerned that things have gotten a little stretched. But at this point, things definitely don't look stretched. And if anything, it looks like it's the beginning of a new trend, and that strong momentum suggests to us that there is a change underway, and that change of foot looks like it has a lot of potential. So again, we're looking at this ratio now advancing and projecting substantially higher. Let's take a look at chart number 5 to get some greater detail on this. So one of the things that we're specifically interested in is the correlation between this pure value, pure growth ratio and the 10-year Treasury yield. Very importantly, when we overlay the 10-year Treasury yield on top of the pure value, pure growth ratio, they have a correlation coefficient of 0.85. So what that basically means is that if the observation that we discussed in chart 1, that 10-year Treasury yields have broken out of this classic pattern base formation and they appear poised to advance to a technical target of around 3%, which would be about a 50% increase over where rates went out last Friday at around 2%. And if we consider the fact that there's an 85% correlation between those two, then that means that there's about an 85% probability that the pure value index will outperform the pure growth index over the same period of time that it takes the 10-year yield to advance from where it is today to around 3%. And we think that it's possible that we could see this process play out before the end of the year, given that time symmetry that we talked about before. And as such, we would favor a pairs trade of being long the RPV, the pure value index, and short of the RPG, the pure growth index. Putting that trade on would give us the ability to count an upside outperformance potential of around 1,500 to 1,700 basis points, or 15 to 17% upside, and that would be relative outperformance. So by being long one of the indexes and short the other, you basically have no net market exposure. You're completely market neutral. Yet if the relationship plays out as expected, the profit potential is 15 to 17% upside. With that, I want to thank you very much for listening to us today. And if you'd like to take a look at our work in greater detail, you can always check out our website at www.jwhinvestment.com or follow us on Twitter at Alpha Insights. Thank you very much, and have a good luck trading this week.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.